Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 148. On today's episode, we will be discussing, drum roll please, the Fed rate cut of 50 basis points. So that's definitely newsworthy. We'll also talk about what's next for the market, and we'll talk about Nike's new CEO. I got Cameron here with me, so we'll get into the topics he wants to discuss. So get your mind right, and let's get to work. Well, welcome back to the show, everybody. Thanks again for joining us this week. Cameron, how are you, my friend?
Good week in the market.
Good week. Good couple weeks. Up, down. It was like up, down, and now we've had like up, up.
Been a little bit of a roller coaster.
Yeah, it's been
but
a little
overall
bit
good.
Yeah, overall, been pretty decent. I mean, gee, what are we going to talk about this week, right? We have the Fed cutting 50 basis points on Wednesday. The market rallied for a little bit, then it completely reversed.
Mm-hmm.
And then yesterday it went way up, right? Way up. Really good day yesterday. And then today, a little bit of softness, but the market kind of fought its way back the entire day.
Mm-hmm.
So a couple things to discuss today. Number one, the rate cut, your opinion on that, my opinion on it. What's next for the market? Couple news items. But were you surprised that they cut 50 basis points?
I wouldn't say surprised, but it definitely, I did not favor 50. I favored more 25.
Okay.
But I get kind of now why they did 50 to a degree.
Yeah.
You know, obviously they don't have a rate decision next month.
Right.
So we're skipping out on that. We only have 2 more for the rest of the year.
Yeah, I did not think they would do 50 basis points. I thought they would do 25. Number one, I didn't think they wanted to be like a political football.
Yeah.
Right? Like they didn't want to be, that they didn't want to be a topic of discussion for politicians. Number two, I didn't think like the market looks that poor. Like I didn't think like the environment is that bad.
Mm-hmm.
I think it's a good point. So to remind everybody, the Fed has a dual mandate, right? That they're kind of their two things that they're trying to work on are number one, price stability. So that's what they've been so concerned about over the past couple of years, which is inflation, trying to bring inflation down. They want that 2% target. It makes it easy for individuals to plan. It makes it easy for businesses to plan, or easier for those to plan. But their second mandate is maximum employment. And so when you look at how this year has gone, unemployment has ticked up. And I think, in kind of a abundance of caution, and like you said, not having a Fed meeting in October gives them a reason, instead of doing like 25 basis points now, waiting till November to do 50 basis points. It's like, all right, we're going to do 50 basis points now so the market knows we're serious. And not just the stock market, but like the market actually in general, like, businesses. And then we'll look to do 25 basis points in November. So kind of reversing that and kind of a psychological move, because they're not going to meet again until after the election.
Mm-hmm.
But they did open themselves up to criticism from politicians.
Yeah. I know that was a big worry for them going into it, right? Like that's what everyone was talking about. It's like that was actually the basis a lot of people were saying as to why they won't do 50.
Right.
It's because they don't want to be considered, as a sway or a mover in the political market.
Yeah. Trump came right out and was mad about it, right?
Yeah.
But I always think about it, like nobody remembers that Jerome Powell is actually a Trump appointee.
Mm-hmm.
And so, they're really trying to make these decisions without it being politically biased. And depending on which side you're on and all those kind of things, it is, but I think they're really trying to do it in a way where like they're really not thinking about that too much.
Yeah. How did you think the market reacted to it? Or what do you think about how the market reacted?
I think the market was, when you look at some of the headlines, the bad thing about like data is that you can go find the data that you want to back up the story that you're trying to pitch.
Yep.
And so you can really, you can go find any amount of data that you want to back up whatever story you're trying to. And that's kind of one of the bad things about finance is that you can really you can tweak the numbers. So the last two times that the Federal Reserve cut by 50 basis points was 2008 and 2020. Not good company if you're keeping score.
Yeah.
Right? Like not good company. And so that was kind of the immediate thing was like, okay, the last two times they did this, that was the conversation you and I had on the phone. It's like, okay, what do they know that we don't know? What are they seeing that we don't see?
Yeah.
That's kind of the negative kind of picture. But when you look, if you widen out the lens and you look at previous data from the 1980s, the 1990s, when you see them cut 50 basis points and it is not followed by a recession, it's actually very good for the market.
Yeah. No, that makes sense. It's funny too, because like when you look at the headlines that CNBC or whoever will post, we've talked about this before, that it's always the fear. They always lean on the fear. So going back to your point about like they'll massage the data however they wish, right?
Right.
You can read one article that says, hey, based on this historically, not great for the market. And then you read another article and it talks about how during this pause period of them raising rates to them keeping it unchanged, this has been one of the best markets historically ever.
Right.
Under the pause period, which is a good sign.
Yeah.
Right.
It means the economy's doing well. It gives, talks about the soft landing. It's also where it's one of the longest times that we've had since they've stopped a raising cycle of stopped raising rates to where they'd make their first cut. It's one of the longest periods of time where we've actually had where they've held rates steady.
It's a good sign.
And so it just goes to show like COVID has messed up so many economic numbers and charts and all the things. I mean, this is the first time. So the yield curve uninverted, right? So the yield curve uninverted. And this is the first time. This will be, if we do not go into a recession, it'll be the first time ever that we've had an inverted yield curve and then not gone into a recession. So there's so many things that basically stack up that show COVID just absolutely just torched so many numbers, indicators, whatever you want to call them. I mean, it's just
skewed the data.
It's skewed the data incredible.
It makes you wonder how they're going to treat it going forward. Like when you're looking at data backwards, do you remove the COVID time because it skews the data so much, the outliers, or?
It just depends on what I'm trying to look at. But like when I do like earnings per share, like I like to look at 10 years. Like when I'm trying to figure out where stocks are going to be in the future, I look at 10 years worth of time. And I don't remove it because I don't we might not have something as bad as COVID, but in a 10-year period of time, there's probably going to be something. And so I just kind of leave it in. If I was going to look at maybe a 5-year, 3-year, now we're kind of out of it on the 3-year, but like, I don't know. It just depends on the length of time that you're looking at.
And with all the crazy headlines right now, how do you, I go back to like trying to take what we're seeing and apply it, right? So like if we're seeing that there's being data that's being not massaged, but cut in certain ways and look a certain direction or the other, how do you as an investor, right? Say you're a retail investor, you're looking at your portfolio, how do you combat that? Do you take in more information to try to see where the skew is, or do you take in no information? Kind of a tough question, huh?
Yeah, I mean, it's tough. I mean, it depends on how much somebody's going to be paying attention. I mean, it's, I look today, so the S&P 500 is up almost 20%. NASDAQ's up 17, Dow's up 11. Dow's
that's a good
still,
market.
It's a good market, right? Yeah, I mean, it's a great year by any estimation. I mean, I still think it comes back to, it's still like, I'm an optimist at heart, right? So, but you think about how many negative stories there have been this year. I always come back to how many negative stories are out there, how well the market continues to do. I mean, like we've gone through, like you and I have known each other for quite a while now, but you look at the last 4 years have not been easy. I mean, when you think about just the time period from when the Fed started raising rates, and they raised it the memory of the market is so short of investors.
Yes. And it's only getting shorter.
It actually is. It's only getting shorter. But people investors don't remember how 2022 was awful. When they raised rates 10 times, it was the worst year for bonds in 100 years. I mean, that was so unbelievably painful, so painful. And so we kind of deserve a couple good years. But it's still, I don't really know, like, how much do I change my portfolio? So you look at the stocks that have done well. What stocks traditionally do well when the Fed is lowering rates, right? Small cap stocks typically do well because their cost of money goes down. Home building, how's this going to impact real estate?
Refinancing, right?
Yeah,
everybody's getting them calls.
Yeah, so I was sharing with Cameron, like, I have clients who literally within 15 minutes of them cutting rates, we're getting phone calls from their mortgage departments.
Yeah,
asking if they want to refinance. I mean, because think about how many, like, that's a real big area of the market where people lost jobs. I mean, refinancing companies went from like 20 people in a department to 2.
Yeah, and you think about, I forget where the article was, but I was reading an article, the National Real Estate Association, NRA, I think is something like that. The amount of realtors that have no longer held a license because of just the market where it's at, or what I see, the 65% of the realtors haven't sold a single home in the last 2 years.
Yeah.
And then the gap is, I think it was 30% have, but only 10% of the 30 sold more than 2 homes within the last 2 years.
Yeah.
How do you make a living on selling 2 homes?
But that's like, if I was in the real estate business, somebody who's really in the real estate business, I'd be so happy to hear that number.
You stick it out.
Yeah, because like that just shows you that when rates were low, that everybody's, people are like, I'm going to get my real estate license and I'm going to sell houses on Tuesday between 10 and noon, 10 a.m. and noon.
Part-time.
I'm going to sell it part. Yeah. I mean, like, so if you're somebody who's really in the business, like if you have dedicated your life to being in the real estate business, you're going to be happy that, like, it's the same thing with the stock market. When the stock market's not doing well, 2022, like these people who are kind of 1 foot in, 1 foot out of the business, for me, I'm happy that they leave.
Yeah. No, I think if you stuck it out and you're good at building relationships, this time is going to show.
I know some real estate people who, obviously that it's been tough, but they have taken, like, kind of like you and I would do. Like they have taken part-time jobs. I know people who have, they're substitute teachers. They're doing things to stay in the business because they at least have enough, foresight to think about how the business is going to be once rates started to come down. Because there is going to be pent-up demand. So now we get into the question of, do I buy a house now, or do I get greedy and wait for the next couple rate cuts? See, because what's going to happen?
Pricing.
Is like, yeah, that's right. Like, am I gonna try to, what's my luck gonna be? Am I gonna buy something now, or am I gonna wait and then maybe get in a bidding war? Because all of the mortgage companies, what they're thinking about is, how low do rates have to get? Yeah. How compelling does the offer have to be that if you're in a starter home and your note is 3.75%? You're in a starter house. You started having kids. You got too many kids now. One kid's in the backyard in a tent. But you don't want to.
Funny.
You don't want to move. You don't want to move because your rate's so low, right? You don't want to move because your rate's so low. But like, what do rates have to get to where you're like, all right, I'm gonna do it. I'm gonna go from a 3.75 to a 6 to a 5 to a 5.5. Yeah. I mean, that's what we're gonna have to figure. That's what the market's gonna have to figure out is where's that number.
How would you figure that out as an investor?
I don't know. I don't know. It's just an open-ended question.
I think
how small is your house? How big is your family?
Yeah.
What happened to your income over the last couple of years?
So there's a lot of factors into this that could skew it pretty good, right? Like if your family grew, optionality isn't there as much as somebody whose family didn't grow.
Correct.
Right? Depending on where you live, maybe safety, schools, whatever, that factors into it. But there's probably, if you look at it, I bet you there is some math you can do around, okay, if the price of my house has gone up, I have more equity in the home, right? Yeah. So when it comes to me moving, I can move that. I have more equity than when I started, which will lower my payment when I move.
Right.
Could offset any increase in rate, right?
Yeah.
So instead of, okay, if I have a 3 going to your example, I have a 3.7 at a starter home, right? Instead of, okay, rate to rate, 4%, I'll wait to 4. Maybe you wait till 4.5 or 5 because you have so much equity in the home you're in now.
Right.
You're coming in with a larger down payment. Your payment's really not going to change.
Yeah.
So that probably could be done in the math. But
Yeah. Everybody's situation is going to be different, but I'll give you an example that I heard this week. Oh, and one thing I want to point out to our audience that for some reason it's one of those things you think you know, but you don't really know sometimes. When you refinance your house, your payments start over. So if
Yeah.
you go from a 30-year note and you've paid on it for 4 years
yeah,
and you refinance, you start over at 30. A lot of people don't realize that. They really don't. So there's somebody I talked to this week. They have a 7.3 and they offered them to refinance, but one of the options was to go to a 20-year note. I forgot what the rate was that they could give them on a 30-year note, but I know that it saved them like $260 a month. But if they refinanced for 20 years, it would go to 20-year note, and it would only cost them an extra $30 a month. So their payment would stay the same. It'd actually go up $30, but they would cut. They've been in the house 2 years. It would cut 8 years off their mortgage. So they're used to making that payment. And that's kind of my lesson to people is like, hey, it's one thing to refinance, but if you refinance, try to get your payments like lower. Try to get if you did a 30-year mortgage, try to do 25, 20, whatever it is. Because this is what happens is they say, hey, we can lower your payment by $200. And people say, great, that's great. I'm going to invest it. And then they don't.
Mm-hmm.
They spend it on Amazon. They spend it on whatever. Uber
lifestyle
Eats.
creep.
Lifestyle creep
happens. Yeah, no, I'm looking at rates right now. So credit score 700 to 720, right? In Texas, 20% down, 30-year fixed 6.9, 15-year fixed 5.7.
6.9. That can't be right.
That's what I'm looking at right now. September 19th, 2020.
Man, you need to work on your credit score.
What would you say is average? So if I move it up, let's go.
I don't know what's average. I'm going to be skewed on that. I don't know.
It's a flex.
Yeah.
So 780 to 800, right?
So 780 is a credit.
Yes.
That's the other. So when you go to a website and you look at mortgage rates and you look at like whatever their advertised rate is, that's going to be their prime rate. That's going to be the rate that you get if you have like a credit.
Yeah. Let's look. This is going to be fun.
I'm trying to get away from the rates.
I thought it'd be lower. What do you think the average credit rating is right now?
I don't know, 700.
717.
Okay.
It's not bad.
That's not bad. I'm trying to get away from those rates where people drive around with bats in their trunk, when they're looking for their payment.
717 is pretty good.
That's pretty good.
So 780 to 800, 6.3 on a 30-year fixed.
That sounds more right. That sounds right.
5.7 on a 15-year fixed. Why would they? So the way you posed that fact, it sounded like whoever you were talking to, the better deal was the 20-year versus.
Of course, yes.
Okay.
Yes.
Why would they do that? Why would these mortgage companies incentivize the 20-year over the 30?
Okay, so how amortization schedules work?
They get more on the.
They get all their interest up front.
Yeah. I was kind of leading the witness a little bit.
Okay, yeah, but no, it's good. That's a great point. I mean, it's an amortization schedule, right? So when you look at your first home payment, I mean, so much of that is all interest. So the mortgage company gets their money back quicker, and then they can loan it to somebody quicker. But that's the thing, like all these companies, they're going to need to do that.
Oh, you know why? Because and well, I don't know. I think they probably do that in the sense that they know that they expect rates are going to continue to come down.
Correct.
And most likely this person's going to refinance again.
Right.
I don't know how many times you can refinance within a year, but they're going to refinance it again. Right.
Well,
so at a 20-year, they're getting more money up front.
Yeah.
There's probably a 1% or 2% origination fee, maybe more.
It's $9,500. That's how much it was.
Flat? Is it a flat?
Flat fee. So think about that. $9,500 a pop, right?
Yeah.
But it's also, so these companies, it's like they can be more aggressive. So the 5.3, it's like, but if that person, think about it, if that person trades out of 3.7 to 5.3, that's a lot better for that mortgage company because they get that money back. They can reloan it at a higher rate.
Yeah.
So I look at it. I looked up like this week. I looked up Rocket companies, right? I'm looking at mortgage like Rocket Mortgage or whatever. I'm looking up different stocks that are impacted by that. I'm trying to find builders.
Yeah.
Go look at Home Depot. Go look at what Home Depot has done.
Home Depot's interesting actually because they've been doing they do retail, but they also have been getting more into commercial.
No, they have so when you look at Lowe's versus Home Depot, they have so much more commercial business. But it's also if you're gonna, you got to redo that bathroom to sell your house.
Yeah. Yeah. So it's funny because you talked about how the mortgage industry kind of dried up, right?
Yeah.
I think the last time I was talking about how I had a friend who had to get a mortgage, right?
Mhm.
And he got a 6.9 or something like that. And I was asking more questions on it. And yeah, he was like, the mortgage guy was working the mortgage with me on the phone while he was also selling credit card payment processing, going door to door. So it's like, there's that part-time
Yeah.
side hustle, right?
That's right. Trying to stay in the business.
That
I mean,
$9,500 is looking real good. So
yeah,
you know,
I mean, it's trying to stay in the business. Well, the same thing happened. Like we had this conversation on I don't know which episode it was, but just talking about like I was giving you a pitch to you about like Morgan Stanley and Goldman Sachs, those stocks during like 2022, because all the IPO market dries up. I mean, every single business is going to go through, I mean, a cycle, and you have to be in a position to be able to ride it out. Like you got to put yourself in a position. I mean, just be glad that you didn't get like, buy a building at 10.5% that has like a 5-year where you can't pay it off or you get penalized for an early prepayment penalty, and then they drop rates. Like somebody, in a building that we're recording in. But I kind of figured like when I bought the building that would happen.
yeah.
That rates would come down, but the opportunity to buy the place was going to be gone.
That's what I'm saying. There's external factors in every decision.
Yeah,
right?
yeah. I mean, that's why we always say for entertainment purposes only, talk to your financial advisor. Cameron could be yours. I mean, all those things. Like you have to like every situation is a little bit different.
So I'm going to throw a curveball in there because
Okay.
we did not put this on the agenda.
Okay.
But you talked about the banks
Right.
and M&A drying up.
Correct.
Recently, Alaska Airlines, Hawaiian Airlines,
Right.
starting to
Starting
come back a little
Right.
bit.
It is
right.
It is. It is from the market
$1 billion
perspective.
acquisition.
Yeah, it is from the market perspective. Is trying to come back, but the other thing too is the political administration right now has done such a, they've been blocking every deal that tries to
They
go through.
let this through.
Yeah, no, I mean, but the other one would be Albertsons and Kroger.
Oh, Kroger, yeah.
That they've been
that's
trying to
right.
get that through. I mean, like because the administration is so harsh towards these kind of mergers and acquisitions, how many deals don't even come up because they never
fear.
think because of fear that they'll just get denied.
Perfect example. Well, they brought it. So Adobe with
Right.
Figma,
Right.
right? They tried to acquire Figma. They had a little bit of pushback very early on in the process.
Correct.
And Adobe pulled out.
Right. And how much did that cost them?
So $1 billion. It cost them $1 billion to pull out.
Jeez.
$1 billion to pull out of that deal.
Well, that's the thing is like a lot of times they'll have some kind of like, what do we get compensated? What's the word I'm looking for? Like, what do we get compensated if it doesn't go through?
It's insurance.
Yeah.
It was insurance for Figma because Figma's price skyrocketed when the rumors came out, right? And yeah, no, Adobe felt that on their
Yeah.
balance sheet quite a bit.
Yeah. I mean, if you lose $1 billion, you probably notice.
Definitely. So all that to be said, though, there's been some acquisition going on. It's going to be nice to see that come back and what that's going to
Possibly.
do for the market.
Yeah.
Slowly.
Well, and that's what I come back to. So the other news is like Nike got a new CEO.
Yep.
Yeah, they're going with like the Starbucks model.
Go Frogs.
Go Frogs, yeah. CEO of I think he's class of 86. Is what I read.
Okay.
What I read. Yeah. It's the only company he's ever worked for.
He interned there right after TC graduation.
That's one of those stories that people like tell you about, but you're like, that doesn't really happen. Like that doesn't really, I mean, it literally spent his entire career at Nike.
Yeah.
1988,
Dedicated.
I think 1988 to today or something like that. Or
It's crazy. I think he like played tennis at TCU.
Wow.
And Nike obviously recruits quite a bit from
Yeah.
TCU. They're mostly athletes.
Yeah. Yeah. One of those, that's amazing to spend your whole, I mean, you just don't hear about that anymore. So we'll see how that goes. They definitely need some help. I mean, that
Market
stock
loved
has been,
it.
yeah, market love. I mean, that stock, and it's been such a good stock and then it just flatlined.
Yeah.
So that was kind of some big news. I called Cameron today. I should have known this, but I called Cameron today. I'm like, I passed by an Apple store. I was like, what did Apple release today? Like, what's going on at Apple? Why is there a line out the door? And what'd you tell me?
New iPhone.
The new iPhone came out. I didn't know you could get it today. And
Yep. pre-order it. You're one of the first people to get it.
Mm-hmm.
Long line.
Yeah, there was. It actually kind of shocking, the long line.
Yeah. Well, I mean, we'll see. The question is what are sales going to be like for the iPhone, right? Like,
Yeah.
there's been, going back to the data, right? There's been so much data lately, even today, just talking about how there was hedge funds that were interviewing the people waiting in line to get their iPhone. Hey,
Right.
why are you buying the
Right.
iPhone? What led you to, and I guess most of what they saw was people it was the fan club of Apple,
Right.
right?
The
I'm
true
buying the new
fans.
one because I buy the new one every year, right? And then the other data is coming around, those phones got to be going from point A to point B to get to the store, right? So some companies got to do that. So that data, how many phones are leaving?
Are they shipping out?
Yeah, are they shipping out? So that data people are looking at, and it's mixed. But I guess T-Mobile came out and they said that 100% they are seeing a higher demand this year for the iPhone than
Wow.
they've seen previously.
Now, we were talking like that. It doesn't have Apple Intelligence yet, right?
So another month is what they say.
Okay.
So, yeah.
In the line, right? Cameron's got this nice new Service Pro. It has a Copilot button from Microsoft.
I love how these companies, and nothing against, obviously tech moves fast, expectations. I get it. I understand. But they'll come out with something, and then the accessibility for certain functionality that drove the demand for that product won't come out for a month. Or with Tesla, bought a recent Tesla, right?
Yeah, right. Yep.
How's the autopilot, the full autopilot deal? Like,
I mean, it works pretty. I mean, so I bought a Tesla Model Y, and I mean, it's pretty incredible. It's pretty unbelievable. But there's still some features that aren't available yet, right?
Yeah,
like
exactly.
summon. I want this thing to be like Batman, Cameron. I want me to
Show
be.
up.
Yeah, I want to be like in a restaurant. I want to say, hey, drive up to the front of it,
Yeah.
and pick me up.
So I think Tesla was the first company I've seen do that, really. And I mean, you probably know the market better than I because you've been around longer, but they were the ones that were selling products with certain functionality not coming out for a little bit, right? Down the road. Never seen Apple really do that.
Yeah.
Purposefully. Like, they've done stuff because of certain sensors and
Right.
legalities, but to release an iPhone where the functionality is, hey, here's a selling point, Apple Intelligence.
Yeah.
You need to upgrade because the iPhone 15, unless you're the Pro, won't be able to use it.
Right. And it's the promise of the future and what's happening. I mean, it's the same thing. Like every time somebody asks like Tesla, when are they going to have like autonomous, full driving, self-driving cars? It's always 1 year away.
Yes.
It's always 1 year away. Right. And so will AI be the same way? I mean, but I feel like there's going to be more features. It's kind of like the internet. I mean, I don't want to be like, hey, I'm the old man in the room, which just sounds horrible. But like, I remember being 16 years old in 1997 and going to like ESPN.com and there was nothing there. There was nothing there. I should be like it's just unbelievable. But it's like, I feel like there's just going to be features added like constantly. So it's more like having something that can be updated. And I guess that's like Apple, Microsoft, like we're coming out with it as fast as we can, that kind of thing.
Is that going to be the new norm? Hey, we're working.
Is it going to be
it.
It is the norm, not the new norm. It is the norm, pretty much.
Buy the product because demand's going to be high. Get it early because you're going to want this feature that comes out 6 months from now.
Hopefully. Hopefully. Who else does it?
They call that magic.
Yeah. Who else does it? What else are we waiting on? I've noticed
how does that impact the revenues of companies? Think about the forward revenue that these companies are getting based off of claims that they're making, future claims. How does that impact? I'm amazed. This is a good segue into Howard Marks in this new letter, but just the fact that like, okay, hey, buy this phone because your old phone's not going to work for this new feature that's not going to come out for another 3 months.
Right. Yeah. I mean, but I've noticed like Google, when I do Google searches, they're using Gemini more at the top, but I'm not paying Google for that. I mean, Google's spending a lot of money to do that. And I'm not paying them anything for it. So that's not, great. It's great as a consumer. It's not great as an investor.
So yes, agreed.
But they know, right? It's a psychology piece.
Okay. Yep.
Which is that habits are sticky.
Yep.
And who you start with, like if later on, like they want your habits. They want they want you to get used to it on their system.
And Also, too, this is a famous. I don't know who started this line, but it's a famous deal when it comes to tech. Is if the product is free, you are ultimately
Yeah, you're the product. Yeah, you're the product.
So Gemini is free, but all that data
Of course.
what you're putting in and what you're looking for,
Right.
because I don't know anybody at Google. I don't know, I followed Google for a bit. I like the company. They own search. They are phenomenal at it. And I do believe that all this data they're collecting is going to be a way for them to be a channel for business.
Right.
So when you go to like these AI tools like Copilot or wherever, right? And you look for certain products, or you ask it a certain question. Imagine if Google now has the ability of giving you the answer, but then also will show you products that you're going to need based off that answer, sponsored products.
Of course. I mean, it's like
And
Amazon.
they can go
Yeah.
to these companies and say, hey, just so you know, last month people have been looking for the best Italian restaurant in Fort Worth,
Yeah. Right.
example, whatever, right?
Yeah.
Wouldn't you want to be the first person, the first company to come up as a recommended offer?
I think about Amazon too, where you see like Amazon shows ads and then it says it can add it to your cart for you, like while you're watching TV, which is wild. I mean, like, and like so many, there's only a few companies in the entire world that have that kind of access to consumers to be able to do something like that.
They just got to make it sticky.
They got to make, but I also think about like, I go back to, and I try to think of the other side of the coin, like from an investor standpoint. And I think about when like Warren Buffett met Bill Gates and he asked him how the internet was going to change the way people chew chewing gum, because he had a huge investment in Wrigley in chewing gum. And Bill Gates looked at him like he was crazy. He's like, what are you talking about? Like, it's not going to really impact like that. It doesn't really impact that business. So I think about like, I'm trying to think about businesses that AI won't impact, that they won't. I mean, not saying they won't impact them as far as like, that they'll be able to do better distribution or whatever.
The way that the consumer consumes the product is not changed.
Yeah, so I think about like a Coca-Cola.
Yeah, people are going to drink Coke no matter what.
You know what I mean? Like, so I'm also
or Dasani.
Or Dasani. So I think about like, okay, I want to know the businesses that are going to be impacted by AI, but I also want to know the boring companies that are not going to be impacted very much, like from a consumer standpoint, by AI, because there will be some companies that literally like go away.
Oh, definitely. I mean, going back to what that famous letter that Warren Buffett had, where he was like, here was the top 20 company or 10 companies back in 19 whenever.
Right.
And it was like none of them around anymore.
Right. Yeah.
Right. So it's like business does change, but the way consumers consume doesn't.
Right. Yeah.
And I think that's why, like, you're going to say something about that?
Well, I was going to say, like, when he talked about how, like, everybody knew the automobile was going to change the world, you just didn't know who was going to win, and you should have shorted horses.
The shovel method, right? Don't go searching for gold, sell the shovels.
Yeah, I mean, like, it's like, what is it, I mean, that's the thoughts I think about, is like trying to think about how consumers are going to use it or not use it or those kind of things,
Yeah, I think that's why our conversations tend to be pretty good, is because I think you think more of the businesses that are unchanged, whereas because I have a background in tech, I think about how does a company take advantage the best in this current situation, right? And it's funny because it's two very different perspectives, but ultimately at the end of the day, it's two companies that are going to make out. It's just which side of the line you want to be on.
Right. Yeah. Yeah, it'll be interesting to see how it evolves. I mean, it's definitely going to evolve like right in front of us. So,
how do you think it will evolve? Like all these companies are doing these, like you got Copilot with Microsoft, you got Gemini with Google, you got all these different AI tools. So if you take out the shovel idea of like, okay, there's NVIDIA that's providing the shovels, but the people that are building the AI models, right?
Mm-hmm.
How do you think one's going to stand above the other?
I like, Microsoft, because they have such a built-in base. Like I feel like the companies that have the base built in, like Microsoft has already conditioned people to pay a monthly fee. Businesses,
you're talking about consumer or both?
Both. Yeah, businesses and consumers. So, I mean, they can, that's what makes me kind of like worried. Not worried about Google, But like Google, it's like they're going to charge businesses, but really consumers aren't really paying anything. So it's kind of where their revenue streams, how can they kind of, you know, I mean, how can they kind of figure out a way to do it? I mean, it's like I sent you that meme the other, or not meme, but or that post the other day about college football and like NIL money. I mean, not that we need to talk about NIL money on here, but like the University of Tennessee adding $10 to all the sports tickets.
Was it 10 or was it
Or
10%?
10%. So that they had
So
NIL
variable.
money. Yeah, NIL money for like their, you know,
Oh
so what companies are going to just add, they're just going to add a fee on top of it, you know, to try to, you know, compensate the cost of this.
Microsoft is very good at that.
Yeah.
They are the bundling champion. And that
Yeah.
they get a lot of pushback because, you know, they'll acquire a certain technology
Yeah.
and they will put it into their bundle. I'm talking about enterprise.
Right.
Consumer's a little different, but
Yeah.
enterprise wise, they'll put it in their bundle, right? And they take, you know, they go to market with it and say, hey, you pay, you know, for Slack, you pay X amount. Well, we'll throw Teams in for free because you currently use our CRM and all this other
Right.
stuff. But then the magic behind that they just nail is that the next year, that bundle, when it comes to renewal time,
Right.
it's going to be a little bit more expensive.
And now you're handcuffed.
You're handcuffed because handcuffed sounds bad, but there's probably some good to it. But they're great at acquiring the technology, acquiring the customer base through free type,
Freemium.
right? But then marginally, right? It's going to be made up when
Yeah.
it comes to renewal time. They're great at it.
Yeah, they are. I mean, they are.
That's why their customer base is so sticky. But then you look at Google, right? And their Gemini product, and they have search. So it's tough. Like, I think if you look at like the companies that do, were you going to say something?
Well, yeah, no, I mean, you can keep going. I'll bring it up in just a
So
minute.
when you look at the companies that try to like, I'm a big fan of Chamath Palihapitiya. He was the guy at Facebook. He was the growth
absolutely
guy.
amazing that you could say that name
Palihapitiya?
properly. Yeah, that's pretty.
Bro crush on this
that's
guy,
pretty-
100%. I remember when I was in high school, I used to like listen to all his interviews. He is a brainiac, but he was the guy at Facebook before Facebook was Facebook.
Right.
He was the growth guy.
Yeah.
He led, hey, how are we going to change this platform from few people know it to like everybody knows it? And he came up with the 5-friend rule, where they looked at all the data and they found that if somebody joined the site and within 24 hours, they found 5 friends that they can match with, their ability to stay on and recommend that platform was so much higher. So taking that same principle, like what's going to be the 5-friend rule
Right.
for these AI tools?
That's so funny. Like when I was in banking, we had a deal like if somebody had, if a customer had a personal relationship with one person at the bank, whether it was the president of the bank or a teller or whoever, just one personal relationship, the percent that they would stay with the bank skyrocketed by having one personal relationship.
Sticky.
It is. Yeah. I mean, the one thing I was going to bring up is about the shovels, about NVIDIA.
Yeah.
But it's not just NVIDIA. It's like all the electricity and all the infrastructure that it takes to run AI. So I was like, I've been looking at Eaton and Dover as like other AI type stocks that aren't really like on the forefront, but of course, entertainment purposes only, do your own research. But Eaton, Dover, those kind of companies. So, and we were talking about like Palantir this week. Monday goes into the S&P 500. I talked about it last week.
Big news.
Palantir, Dell. I didn't get all 3.
That's really impressive.
So, I mean, it's nice to see those going. So, but speaking of AI, so I've talked about a little bit like my interview with Guy Spear next month almost. But Cameron has been very much helping me out. So Guy Spear has been doing all these interviews. We should probably, like, we've almost been going 40 minutes. We need to do this on another episode, but we've been using AI to kind of go through all his interviews.
Yeah.
Because I don't want to ask him questions that other people want to ask him. So we need to do another episode where we talk about like how we're using AI to look at like what other questions people have been asking him and then come up with questions that we want to, you want me to ask him.
Definitely. I'm looking forward to it.
So we got anything else? What else do we have on here?
We covered a lot. I think that's pretty good for now.
Good. All right. Okay. All right. Well, as always, don't mistake activity for achievement, and we'll see you next time. Thanks, everybody.